Gold has just exploded higher, and I'm going to explain to you why it happened. My name is John, Senior Market Analyst at Anzo Capital. Before we get started, hit like and subscribe. It really helps the channel to grow. So let's get straight into it. Looking at the news squawk, around about 12:33 GMT, there was a release that said the US Treasury is increasing by at least double the size of liquidity support buyback operations for longer dated nominal coupon securities, from the current US dollars 2 billion to at least US dollars 4 billion as of September 9th. Now what that basically means is they are buying long end bonds. And if they are buying long end bonds and they're doing it to the point of double the amount of usual, that will drive bond prices lower. And that's exactly what happened. First, let's take a look at the 10-year bonds reactions. We were trading around about 4.7% on the day. We started to give that back overnight of yesterday, and then into today's session we were actually a little bit more bid until that data dropped, and we saw a huge drop going from 4.7% down to at least 4.65%. If we look at this from a daily chart point of view, this market has been in a very tight trading range, but has been leaning a little bit more to a bullish side. If we take a look at the 2-year yields, a little bit of a different story. We did initially have some downside, but it rejected on the US Open and continued to drive higher. So a little bit of a mixed bag here, but the long end yields, look at the 30-year, is dropping significantly because of this buyback situation. Now the 10-year yield has a very strong correlation with gold, and obviously the 2-year too, but the market is focusing more on the 10-year bond yields at the moment, that longer, that more middle ground US yields. Now the thing is, with gold, it is a non-yielding asset. So when bond yields fall, people prefer to hold their capital in gold. And when we take a look at gold, we can see the reaction here. The market really aggressively rallied, punching through some key structure points, including the likes of this key area high at $4,440. Now we did talk about the potential long coming in on gold, and we were looking for the idea that we would find support, continue to push to the upside. One area we looked for that was down back at these 4-hour lows. We also looked at this $4,250 area as a level of support too, but price found this area. We consolidated. This news then came out, which pushed gold prices a lot higher, breaking through key structure highs. So now we have to ask ourselves the question, where is gold prices going to go now, and will it continue? I do think it does continue. Not only do we see gold prices breaking out technically, we have lots of fundamental backing. The only thing that can change that maybe is the FOMC meeting minutes that will be coming out tonight. So by the time you see this video, you might not see, we might not see the reaction from that. But don't think that's really going to change much of the story here for gold. We have poor US data. We have poor inflation data. We have weakening jobs. We have a growth that is stalling. Those are all things which suggest actually we're not going to really see rate hikes. And that is also being priced by the CME FedWatch Tool, which is showing us that the bond market is not pricing in rate hikes as what we were expected to see earlier in the year. If I go back to the CME FedWatch Tool, we can have a little look at where bond traders are pricing themselves in the markets. Now what this tool does in particular, if you are unfamiliar with this tool, this is taking the 30-day Fed funds futures prices and pricing it in to a graph format. And what we can see is, as time has gone on, we've gone from being 70% of a rate hike coming to now 63.4% of no change. That's why we've seen this catalyst of the US dollar weakness. And if that does continue, that means bond yields are likely to fall. And if bond yields are likely to fall, that means there is a good chance that gold continues to climb to the upside. So when we're looking at these prices here, we need to look at where we could potentially look for obviously some resistance. So we do have resistance up at this $4,600 level, maybe even up at the $4,750, $4,760 area. Those areas there could be good targets for price. Now what we cannot do as traders is FOMO into this. If we try and buy into this move here, the next area of resistance here, not great in terms of reward to risk, right? If I was to draw the reward to risk tool on with a long now, stop loss below the low, that next target is a negative reward to risk. That doesn't work for us. We need a better one. So what we need to see really is price come back down towards that $4,400 high in order to have a strong trading opportunity. Very similar to what we talked about down here, right? When the market came in at this area here, we said, we can't buy that. We came back into this area. We can't buy there because the reward to risk isn't great. We need to wait for price to come back to a low area first in order to be a buyer of support. So remember, consider that going into next week or the next few days of trading gold prices. Don't try and get caught into the FOMO trade here. There will be other opportunities. So to end that there, my name is John, Senior Market Analyst here at Anzo Capital. If you did like the video, please support by liking and subscribing to the YouTube channel. It really means a lot to us here. Thank you. If you have any comments or questions about anything at all to do with markets, CFDs or the broker, drop them in the comment section. Speak to you soon.